Right, I'm looking at the attendee list here, and I see almost all of our community of practice members and a bunch of other friends to ULI who are joining along the way. Thank you all so much for being here. Really appreciate it. I'm Wes Craiglow. I am the executive director of ULI Northwest Arkansas, and I'm very thankful you're here today for Market Moves. Really looking forward to sharing a lot of the story of what's going on right now in the residential marketplace throughout the country, and in particular here in our neck of the woods of Northwest Arkansas. A little bit about ULI for those of you who may be joining us for the first time. We are a trusted and relied upon network of leaders advancing responsible land use and development. Our mission is to shape the future of the built environment for transformative impact in communities throughout the world. ULI is the oldest and largest network of cross-disciplinary real estate and land use experts in the world. We are our members. It is through our members' dedication to our mission and their shared expertise that ULI has been able to set standards of excellence in development practice for 85 years. Joining us today for Market Moves are Gregg Logan and Mervyn Jebaraj. Gregg will be starting. We'll kind of take a look at some of the broader national themes going on in the marketplace, and then we'll be hearing from Mervyn following Gregg, and Mervyn's going to dig in deeply to some of the most recent research here in Northwest Arkansas. Gregg Logan is managing director of RCLCO. Gregg has over 30 years of experience in real estate consulting. He has managed market and economic research and analysis engagements throughout the U.S. and abroad. He's a trusted advisor to developers, investors, landowners, cities, counties, foundations, religious institutions, and he provides market and financial feasibility, strategic planning, economic development, and large-scale envisioning services. He's a contributing author of several ULI books, including Transforming Suburban Business Districts, Developing Active Adult Retirement Communities, and Housing for Niche Markets. He's chaired ULI's Atlanta's District Council, Central Florida District Council, and the Senior Housing Council. Very honored and pleased to have Gregg with us here today. And Gregg, with that, I will hand the microphone over to you. Thank you for being here.
Well, terrific. Very nice to be with you all here. I'm just going to launch right in. I'm going to share some things that are going on nationally, share a little bit about our economic point of view, and then talk about what we found with some of our national surveys, and then end with where it looks like the market is going at a macro level. We do a sentiment survey every quarter. This is the last sentiment survey that we did in January. This is, of course, before Ukraine invasion and all that. But this just shows you, over time, how real estate practitioners have been feeling about the market. And there's about 3,000 people who answered the survey across the real estate industry. This is not just residential. The current RMI, real estate market index, sentiment index in blue sort of tells you how people are thinking about the market right now. And then the dotted line is how they predict things will be 12 months later. So this is at year end 2021. You can see that sentiment had popped up over the depths of 2020 and popped up in 2021. And then we're waning a little bit, people still feeling optimistic about where things are going, but then starting to fall off a little bit year in 2021. RCLCO, tries to maintain a point of view. We do market analysis studies all over the country from our offices around the country, and every report, we have to provide context for what we think is happening. And this is sort of our latest thinking on that context, and I'll get into some of the real estate specific factors. But obviously, the Ukraine invasion, poses some risk to Europe. It could throw Europe into recession. Europe is the U.S.'s biggest trading partner after Canada and Mexico, and so that could put a dent in our ability to continue to see recovery. Although I think we're at about 85% of jobs recovered from the depths of 2020. And one thing we have to keep an eye on is what happens with energy costs. Even though we're not buying energy from Russia, they are contributing a pretty big share, up to a quarter of Europe's energy. And so as that is impacted, that impacts, as we've already seen, oil prices all over the world. And gas prices are up here, and so that could have some negative impacts. We were looking at inflation as a concern, and most economists were saying they thought inflation was really going to peak this quarter. And now with the impact on energy costs in particular, that probably drives that back to the end of the year at least, or into 2023. And so, that's not a good thing for getting costs under control, but sort of a wild card that none of us expected. We do our overall read on the U.S. economy is we expect it to continue its growth. The growth that we saw in 2021, but we expect maybe that'll be a little bit slower in 2022, given what's going on with the economy. And of course, COVID remains a wild card. Let me just back up a second. So I did have on the other part of the slide there is looking at just where near-term inflation expectations are, and just showing in the red line that we're pretty well above normal market trends. But if you look at where we expect that to be, back on a 5 to 10 year trend, it flattens out. And then continuing thinking about the overall economic point of view as context for the housing conversation. The Fed has already signaled that they're going to be raising base rates, the Fed funds rate over the next few months. That they our expectation is that will stay below the long-term averages, but we're already seeing mortgage interest rates ticking up a little bit. They're not the same thing, but they influence each other, and I'll talk a little bit more about that in a few minutes. When we again looking more broadly at real estate, not just residential, but there's a lot of capital out there for real estate. Abundant equity for investing in deals, a lot of what we call dry powder for opportunistic capital for investing in opportunities, and plenty of debt availability. So capital is not a problem, and the capital is priced competitively. Just sort of going through our expectation for each of the different real estate product types. Single family and residential, which we'll talk most about in the rest of the slides today. We think it's going to excel, based on the demographic drivers. Prices and costs are a factor. Rents, rapid rent escalation is a factor and concern. Multifamily, same thing. The job growth. We're running into some headwinds on job growth, just because there seems to be a little bit of a disconnect between qualified prospects and the jobs that are listed. And we've got very strong employment already, so that creates a very, very competitive market. But we have seen very good job growth over the last few years, and that job growth has helped to support both for sale and for rent demand. Industrial obviously staying very strong as e-commerce continues to expand. Office, we're seeing a lot more return to office as people, at least psychologically, put the pandemic behind us, even if we have a bit of that still going on. It does seem that return to office, or at least sort of a blend of return to office and work from home, are helping office come along. And then retail, overall, we think the retail supply is going to shrink. It was already shrinking before the pandemic because of the shift towards more and more online. Grocery anchored centers, we think, will continue to be fine. So current residential real estate outlook, some of the same challenges that we had in 2021. The demand is there, but hard to capitalize on that demand. The new wild card, besides the pandemic, it's always something, right? And then we have the war in Ukraine. Maybe that influences the economic recovery to be a little bit slower. Right now, there's so much pent-up demand, and the market has been so undersupplied that the effects of that are blunted. We still have historically low interest rates, even though we see those ticking up. We still have very strong demographic tailwinds with the millennials, more and more of the millennials coming into the housing market. We've all seen and talked a lot about the whole pandemic-related influencing of people to think about needing more space or being able to work from a distance, and how that's had an impact on driving suburban and rural resort second home demand. The greatest challenges, just like last year, continue to be related to supply and materials and supply chain issues. We don't like to talk about this a lot in our industry, but the fact is, after the great financial reset, the Great Recession and 08, 09, we've undersupplied the market for a long time. And then you add on that the supply chain issues coming out of the pandemic and that are now we've slowly been resolving, but maybe a little more difficult resolving them as with the war and so forth, just contributing to delays, and that's keeping pressure on prices. And of course, those pressures on prices have not blunted demand too significantly, but we are seeing some slowing, and part of that is where prices are going. So key trends. I think I already mentioned, that we thought we were, about to put inflation in the rearview mirror, but Ukraine is complicating that. And we have seen, in January, and we were looking at what was happening, across the world, and saw that, the materials that were such a problem last year were becoming increasingly available, still at a higher price, so still having an impact on ability to get prices reined in, but helping with timing a little bit. That's probably going to be slowed down a little bit by the war. Given the labor market constraints, builders have been challenged to keep housing in the range that more people can afford it. We do have to be reminded that the share of the market that buys a new house is less than 20%. And a lot of people are buying resales, but the resale market's so tight, and that's driving more people into the new home market. And so, the long and short of that is that, demand is likely to stay pretty strong throughout 2022. And although we do have some challenges with jobs and matching positions to training and so forth, overall the forecast, this is from Oxford Economics, is adding about 4.4 million jobs in 2022. We do a master plan community survey. We track about 300 communities nationwide, and we publish a list of the top 50 communities. We published this earlier this year. The top selling community was the Villages, an active adult community, and another Florida project, Sarasota's Lakewood Ranch, which is the top selling multi-generational community, with a 20% growth in sales over 2020 and 2021. So even though the market overall was a little bit slower, what we saw happening in community development was stronger sales. And we've done a lot of consumer research, talking to people about what sort of community that they want to live in. And we find that there's more demand for community development, master plan communities, communities with amenities and lifestyle in addition to, house and lot. And we find there's more demand than supply. And that really shows up in the survey of the 300 that we're tracking and the 50, the top selling that we published. The Sunbelt markets overall, and you are part of that South market. Part of the SMILE includes Northwest Arkansas. The Sunbelt markets, dominated the top selling communities. Florida was about 40%, Texas 26%, Nevada 12%, the Carolinas and California sort of rounding that out. But you can see on the list there of top communities, really strong sales among master plan communities. And some of the key trends that we're following there among the top selling communities is that again, the master plan communities kind of rebounded much more strongly than the market overall. And the little whack-a-mole image on there was meant to be cute about the fact that what we heard from builders and developers, last year, and when we were finalizing the survey at the end of the year, was that builders just felt, as soon as they'd solved one problem, then another problem popped up in terms of we couldn't get windows, now we can't get doors. So that was sort of a common theme, which we reckoned the whack-a-mole model of real estate development. So lack of inventory, was the most frequently cited reason when we interviewed master plan communities about what happened with their sales this last year. Was builders were telling them, we're going to close as many houses as we can close, not as many as we can sell. We could sell more, the demand is there, but we just can't close any more than that. Overall, the demographic tailwinds I mentioned earlier continue to favor single family development. We saw this last year. I'll show you a little bit of a summary of who the buyers were this last year at a national level. It's not just the millennials coming into the market. We're still selling one more time to the boomers as they're moving into retirement or buying in active adult communities. And then of course the millennials are the biggest share of the market. And those low interest rates continue to be a facilitator of new home purchases, especially for first-time buyers. That's one of the reasons why we want to keep our eye on rates and keep our eye on affordability and price, just because as rates go up, we've already seen really strong growth in new home prices. That has a big impact on the affordability of this very significant segment. And of course, as we've all talked a lot about, how long work from home trends continue is related to the increase in purchasing in suburban and exurban, and even the boom we're seeing in resort and second home areas where people realize they can work from anywhere at least part of the time. So this is looking at the most recent statistics through January of 2022 on what's happened with permits, starts, and completions. Permits are a leading indicator. So the permits are ticking up. So you saw we had very, very strong buildup across 2020, and then it really fell off in the summer of 2021. And we saw that ticking back up in the fall of 21 and continued to tick back up, through January of this year. So that's a good thing. But then we look at the starts and the completions, and we see that those are kind of bouncing around and trending down again. And that's the supply chain issues. That's looking at what's happening. Maybe rates are a little bit of a factor, but mostly that's housing production being held back by the supply problem. So the leading indicator permits suggest that the demand is there. The sort of popping down along that 1.2 million mark with completions is really the issue with being able to meet the demand that's there. When you look at how's that's translated into new single family sales. The previous slide here, this is looking at all housing, looking at single family sales in particular. So the gray bar is the prior year, the dark gray bar is the current year, and then the blue line is sort of year over year change, and the red line is month over month change. And so you can see new home sales dropped a bit in over the summer. It really had grown significantly in 2020, dropped a bit, popped back up in the spring of 2021, fell off in the summer and started to rally and strengthen in November and December of 2021, and then have kind of fallen back off again a little bit. So now we're at about a seasonally adjusted annual rate of about 800,000, and that's down almost 20% from where we were back in January of 2021. We've also seen supply pop up a little bit too. And part of that is the supply chain issues. Part of that is looking at what's happening with the prices. Average sale prices are high; they're historically high, and rates popping up a little bit makes them a little bit less affordable. Overall, when we look at incomes, we have seen some wage growth, which is a good thing. That helps. But there hasn't been wage growth has not gone as fast as price growth, and so the pace, we're saying that the price gains, the pace of price gains from last year, it's really not sustainable. We can't keep up that pace in 2022. Well, we can, but not without seeing that impact where sales go overall. So we're assuming that we get that under control. But again, looking at where prices are really significantly up, just as we saw sales volume off by almost 20% January to January, we see the average sales price of a new house up almost 20% year over year, and that's just not sustainable. One of the things we saw coming out of the Great Recession, the Great Financial Reset, was where we had a broader variety of housing and different densities of housing and different product types of housing really proliferate. Pre 2008, coming out of the Great Recession, we saw everything really sort of fall back into being predominantly single family. And part of the reason for that was single family became so affordable. And now we're seeing that affordability really being challenged. And so the opportunity or the challenge or the need for all of us in the housing industry is to go back to thinking about how do we create more attainably priced housing. That includes a lot of the single family for rent product we're seeing, but also thinking about some higher density, some missing middle housing forms and things like that to help bring affordability back. When you look last year at where buyers were, you can see again the younger millennials and the older millennials being a big chunk, being well over a third of the market, but then the older boomers still being a pretty big chunk of the market too. And so we're still needing to have housing for the Xers and the boomers. The Xers and the boomers have a better ability to deal with the price increases that we're seeing. The younger millennials, not so much, and they're a significant part of the market. So that brings us back to thinking about how do we introduce some of that missing middle for sale product, as well as understand that that's really driving a lot of the single family for rent and build for rent. Looking at where volume is occurring across the country, it's the South, that South region, really from Texas to Virginia, that southeast portion of this U.S. smile there, where the greatest home development has been, and really much less so in the Northeast and in the Midwest, in the West a little bit too. Home builders by and large are pretty optimistic. If you look at the line there, the bottom line on that chart, the traffic of prospective buyers, you can see traffic fell off a little bit in January and February. So that's something to keep our eye on. Overall, pretty optimistic. Home builders are pretty optimistic. They're not where they were, in October, November of 2020, but they're above the doldrums that we saw, back in the summer of 2021. But some concern about fall off in traffic in response to what's happening in the world, rising interest rates, decreasing affordability, and so forth. So all things we need to keep an eye on. And this is the interest rate picture. This is zooming on a fairly short-term period, but if you look at where we were in 2020 as sales really picked up, and then looking at how interest rates are ticking up a little bit, we probably will end up the year closer to 4, which is still historically low, but higher than where we have been, and does have an impact when you combine that with what's happening on where prices are going, and has a big impact on housing affordability and the ability, particularly those millennial buyers, to stay as active in the market. Existing home inventory, remains very low, and that's not great news overall for the housing market. It does tend to push more people into the new home market and keep the pressure there, and just one more of those factors that's helping to drive strong sales. When we look at existing home sales, they did tick up a little bit in January after falling off in December, but overall kind of hovering around that 5.5 million mark as they have since around September of 2021, and that's for single family. And then we look at attached sales as well. We can see that they've been pretty constant. That condos, townhomes, and so forth have stayed at a pretty constant pace of sales. This is looking at Fannie Mae's most recent forecast. They just published these numbers in February of where they expect new single family sales to go nationally. So you can see how single family sales sort of trailed off towards the end of 2021, off to a decent start in the first quarter projected, and Fannie Mae's expectation is that's going to level off, but be more similar to where we were in early 2021. Not reaching the heights of 2020, but improving over where we were last year. But again, this is assuming that we continue to see the supply chain issues resolving, and can get a handle on the strong price appreciation and interest rates stay below 4%. That's all baked into the forecast. So with that, I will stop my screen share and throw this back over to Wes. Wes.
Thanks so much, Greg. Very, very informative. Appreciate all the work that goes into preparing that sort of research and analysis. We're going to hold on to questions, Greg, until the end. We're going to let Mervin jump in here, and then we'll just do a collective Q&A there at the end. So everybody, keep the questions formulating for Greg in your minds. Please feel free to hold them to the end or just drop them in the Q&A section at any time. I want to note, Nicole's, make sure that I go ahead and say it. These slides, we will get these from our presenters today and make sure that they are shared on our website very soon. Without further ado, would like to welcome Mervin Jebaraj. He's the director of the Center for Business and Economic Research in the Walton College of Business at the University of Arkansas. Mervin has contributed to economic thinking and public policy discussions that journalists, business people, and community leaders alike rely upon to understand how national and regional issues impact Northwest Arkansas and Arkansas as a whole. Arkansas Business and Northwest Arkansas Business Journal recognized Mervin in their 40 under 40 lists and the Arkansas 250 list. He makes presentations that share the center's expertise directly to over 5,000 individuals annually and tens of thousands more hear and see his economic analyses and commentary through television, radio, and print media. Jebaraj serves on the Community Development Advisory Council of the Federal Reserve Bank of St. Louis, the Board of Directors of the National Association for Business Economics, the Board of Directors for the Northwest Arkansas National Airport, and on the Board of Directors of the Walton Arts Center. Mervin, thank you very much for being here. Welcome back to another ULI audience, and the floor is yours.
Thank you, Wes. You make me sound that I'm bored all the time, it looks like. I do want to, I think maybe some of you that live around here locally have seen the headlines of our News Skyline reports. We do have fresh data on what's going on in real estate in Northwest Arkansas. So I'm going to show you some slides with some data, talk about a few things, and then Greg and I will take questions at the end. So I don't know, you know, I guess it depends on your flavor of which media organization you looked at, but the headline either varied from, you know, the ridiculously high prices in Northwest Arkansas or the record number of homes sold in Northwest Arkansas. So let me start with the record number of homes sold in Northwest Arkansas. That was the case in the second half of 2021. That's all the way through till December. We sold a little over 6,000 homes in Northwest Arkansas, and seeing as how we have data going back to 2004, which was the last time, 2006-ish was the last time we had a boom market in Northwest Arkansas. We're fairly confident in saying that even though we don't have data going back before 2004, there's probably never been home sales at this level anytime that far back. So about 3,700 of those homes were sold in Benton County, about 2,300 homes in Washington County, and just over 100 or just under 100 in Madison County. So across the board, we're seeing, as Greg had mentioned, homes being purchased by young families, people wanting to move into bigger spaces with working from home and things like that. But we're also seeing quite a bit of action, we think, from investors, and I'll talk about that here in a little bit. So just a quick overview of some of the bigger cities in Benton County. You can see, fairly consistently across the board, we've seen an increase in the second half of 2021's home sales. Maybe not as high in some cases as the home sales amount numbers in some Benton County cities in the second half of 2020. But there was quite a bit of home sales in 2020, a brief lull of the first half of 2021, and then a real pickup again in the second half of 2021. And I wouldn't be entirely surprised to see a lull again in this half. We have some of the lowest inventory numbers we've ever recorded. So the number of homes listed for sale has dwindled again, but that could change. I think there is a sort of home selling, home buying season, and we're about to enter it. So that could change very shortly. Same story across the board in Fayetteville, Springdale, and West Washington County, which is, several smaller cities like Prairie Grove, Farmington put together to, add up their data there. But, Fayetteville, obviously, we're seeing a lot of homes sold. This is, some part of this is because there's a lot of home construction going on in the city of Fayetteville. Springdale, not seeing a whole lot, and you can actually see that the number of homes sold has declined over time. And there was a small increase in the second half of 2021. And that's in large part because there is quite a bit of land available to develop in the city of Springdale. A lot of it is held by a very few number of developers, and they're moving at a much slower pace than, say, the developers are in Fayetteville or in other cities around Northwest Arkansas. So there's quite a bit of development potential still out there in Springdale. It's just not being developed fast enough compared to other cities. And once that hits the pipeline, I think you'll see the number of home sales in Springdale pick up as well. So the flip side of having a record number of homes sold, so if that was the good news, this is the bad news. Home prices on average have risen quite significantly. In Benton County, about 18% last year. In Washington County, about 16% last year. The average home price in Benton County now about $346,000, and in Washington County about $311,000. In both cases, that's around a 55% increase over a 5-year time period. So that is not a sustainable level of price growth, especially given that I've said this a few different times, I suppose, but in the last year, if I remember correctly, we made it to, I think we were the 4th best place according to the U.S. News and World Report. We, for the first time, I believe, displaced Austin, Texas. And one of the biggest contributors to those rankings tends to be the cost of living. And the biggest contributor to the cost of living tends to be home prices. And so one of the reasons why we had displaced both Austin and Denver over the years is because their housing had over time gotten a lot more expensive and had started lowering their rankings relative to where we are. So, what I don't want us to do is follow the path of some of those cities that have really high cost of living that is affecting those rankings in those, and it does prevent people from being able to move to those regions. So we do have high home prices for several reasons. The pandemic did spur a whole bunch of home buying. People wanted to live in homes as opposed to apartments. People moved to Northwest Arkansas, as we'll see here in a few slides. But we're also seeing, given the tight supply of homes in our market and in markets across the country, we're seeing a lot more action from investors. We don't have exact numbers on how many sales are going to investors in Northwest Arkansas, but from the National Association of Realtors, we saw that 22% of home sales in January were by investors, 27% of transactions in the same month were all cash offers. When we are still trying to figure out how to dice that data for our local real estate sector, but one easy thing that we've looked at is the number of homes receiving the homestead tax credit. So if you're a homeowner living in your home in the state of Arkansas, you get a tax credit for that on your property taxes. And it gives us a proxy to look at how many owner-occupied homes there are in this region. And 10 years ago, we probably had owner-occupied homes in Northwest Arkansas in the high 60s. Today, it's in the low 60s. And there was a significant decrease in owner-occupied homes, especially in the last several years. So, we again don't have data. We have that piece of data, which is again all homes, not just new homes. But we have seen instances where new homes are being constructed in subdivisions, and investors buy up a tranche of, say, 10 homes in a subdivision, then put them out to rent. Again, a lot of that investor activity is driven by the fact that investors believe that not only our region, but other regions across the country won't build as much housing as is needed to keep up with demand, and therefore prices will continue to go up, and that investing in single family homes is a relatively safe bet. So, and that's just stuff that you can hear on, large national investors on their earnings calls and so on and so forth. They would talk about what they expect, housing growth to be, and how they think investing in single family homes is a safer investment. So I would encourage us as a region to, I guess, make some investors lose their money, I suppose, by building more homes and pushing the average prices down. This is the average home price in the bigger cities in Benton County. Again, 67% or so increase in Bella Vista, 53% over 5 years in Bentonville, Rogers about 55%, and Salem Springs about 43% or so within downtown Bentonville. So, the overall average home price in Bentonville is $429,000. The average home price in downtown Bentonville, which is the largest downtown in our region in terms of area, is $653,000. So there is a significant premium on home prices in downtown Bentonville compared to the rest of the city of Bentonville, which already has some of the highest home prices in this region. Downtown Rogers compared to overall Rogers is not that different. Again, downtown Rogers is not significantly a large area, say compared to downtown Bentonville, and also does not have as many single family homes in the inventory compared to downtown Bentonville does. So the overall, home price average in Rogers is $390,000. In downtown Rogers, it's $395,000. Thing to keep in mind, obviously, is that the downtown homes tend to be smaller. So, when you're looking at these changes in home prices, especially in the city of Bentonville, where you're looking at, well over $200,000 difference in the average home price, that's a significant premium that people are paying to live in the downtown region. In Washington County, the home price in Fayetteville on average is $317,000. Again, over a 5-year period, that was a 36% increase. You will note that that is lower. Generally at the largest cities that have been highlighting, the increases have been north of 50%. In the city of Fayetteville, the home price increase over 5 years is still significant, but it's about 36%. And that's in large part because of this time period here, roughly between, say, 2017 and 2020, before the pandemic, where there was quite a bit of, significant amount of home building going on in the city of Fayetteville. Newer homes were coming on the market in denser subdivisions, so much so that the average size of a new home in Fayetteville shrunk by about a room. So, that pushed the overall price of new homes being sold down, and helped kind of, flatten this curve of all homes being sold in Northwest Arkansas. In the city of Fayetteville. Obviously, the pandemic and the increase in demand, there's still new homes being built in the city of Fayetteville at fairly large scale. They still are smaller, but the, rapid increase in demand has meant that those new homes are no longer helping keep prices flat in the city of Fayetteville. But when you look at a 5-year average, that's the reason Fayetteville has a lower average home price than some of the other cities in Northwest Arkansas. I would also add to this that the politics of the city council, I suppose there is some consequence to permitting a large number of denser subdivisions in the city of Fayetteville. The politics of the city council has significantly changed, so I would not expect, at least in the near future, a lot more permits to go through for a lot of dense subdivisions in the city of Fayetteville. So the city, I did want to mention downtown Fayetteville, again, fairly significant amount of homes being sold there. The average home price there is $365,000, so about a $50,000 premium in downtown Fayetteville compared to the rest of Fayetteville all put together. In Springdale, the average home price is $283,000, a 52% increase over 5 years. Downtown Springdale, I believe, if I remember correctly, has one of the smallest footprints of the 4 cities in terms of what is considered downtown Springdale. There isn't a lot of homes there, and they tend to be older and more run down. So the average home price in downtown Springdale is a lot lower. It's $169,000, but that is not looking at comparing apples and oranges to, it's sort of comparing apples and oranges with downtown Springdale with Rogers, Fayetteville, and Bentonville. And then West Washington County, the average home price is $237,000. Again, over a 5-year time period, that's a 53% increase. So, with the exception of, say, Springdale, which we talked about why that's different, we are seeing significantly more expensive homes in downtown Fayetteville, especially in downtown Bentonville significantly. And that does have to do with the fact that there is generally less land available, that land has been zoned for its current use, which in many cases is being underutilized, the amount of land. There is some amount of difficulty with developers working in tighter spaces in those downtowns compared to, say, getting a subdivision on the outer edge of town where they can, work a lot easier. And then there are, even if downtowns allow for greater density in general, the code book is sort of inherited from a long time ago. And so there are still a lot of other pieces that might be affecting the ability to build density at any scale. And those include things like parking minimums at downtown houses, how many parking spots are required to be provided per dwelling unit. That significantly increases the cost of the development, as well as increases the amount of space needed to make that development viable. If we have to dedicate a whole bunch of land over to parking, there are frontage requirements. There are, how much space you got to leave on either side of your lot. So again, we have tried to sort of, at least in some of the downtown regions, try to allow for more density without having addressed some of the other issues from other parts of the code. So it's not just enough to say all these uses, mixed use developments are allowed in these regions, or we're allowing greater density in the downtowns, but we haven't gotten rid of some of the parking requirements or some of the frontage requirements or some of these other things that make it a lot more difficult to build denser housing. So one of the things that we really do need to do as a region is, and maybe I could talk about this during the questions, is look at how our code books are written across our 4 cities, and stop tinkering piecemeal with the code book and start over and think about what do we want our cities to look like, and how should we write code to make cities look like what we want them to look like, as opposed to sort of tinkering constantly with, let's change this section here, and then it's still not getting us what we want because there are 10 other sections that affect how homes are built in our regions. Here's my crude measure of housing affordability. It's the housing median multiple. It simply takes the median home price, divides it by the median household income. If that number is 2.5 or 3, it's generally considered affordable. As you can see in Benton County, that number is, significantly higher than 3. It's about 4.2. Median home price in Benton County is about $289,000. The median household income is just under $70,000. In Bentonville, the median home price is $385,000. So even against a median household income of $80,000, the median multiple there is 4.8. So it takes 4.8 times the median household income to afford the median house in the city of Bentonville. Median price in Rogers is $320,000, and the median household income is about $66,000. So again, it's 4.9 times the median household income there. Washington County is not faring a whole lot better. As a whole, Washington County has lower median incomes than Benton County. So the median household income in Washington County is about $51,000, and the median home price is about $265,000. So that's more than 5 times the median household income to buy the median house in Washington County. In Fayetteville, the median home price is $276,000. The median household income is about $52,000. And yes, I did take out the effect of students. So this is the median household income without students. And so still that's about, again, more than 5 times. And in the city of Springdale, median home price about $256,000. Median household income of about $48,000. So again, about 5.3 times the median household income to buy the median house in the city of Springdale. So as I mentioned, we've seen a 55% or so increase in home prices in both counties, and in 4 out of the 5 major cities in Northwest Arkansas. We have seen significant wage increase. We saw a significant wage increase in 2019 before we went into the pandemic. There's been significant wage increase this year as well. But we can all agree that wages have not gone up by 55% in the last 5 years. So certainly wages are not keeping up with the increase in home prices. So we talk about the reasons for why we are seeing such an increase in demand for homes. Obviously, is that our population is growing. This is the change between the 2010 and 2020 census. Usually about this time, we should get, intercental population estimates for Northwest Arkansas, but that data has been delayed by the census. So again, so we're stuck with what we had in 2020. You can see the significantly faster growth in Northwest Arkansas compared to the rest of the state. When we look at in-migration data for our state, for our region, Northwest Arkansas and then in Washington County, the data is a little bit old. Again, we're waiting on new data on that stuff too. But at the time, at least up until 2018, a little over 40% of the people moving to Northwest Arkansas were coming from other parts of our state. So they were coming from one of the 73 other counties in our state. So our home prices at that time in 2018 were easily over $100,000 higher than the next highest county in our state, and now it's a lot higher than all of that. So for the biggest chunk of people coming to our region, we are very expensive. So especially if they're trying to sell a home in one of these other counties and move to Northwest Arkansas, we are already very unaffordable for that region. So in terms to get you an idea, at least within the last 5-6 years of how many people are moving to Northwest Arkansas, 2020 saw a significant increase in the number of people moving to Northwest Arkansas. But like if we ignore the pandemic related moving and just look at the sort of long-term trend, in Benton County, about 7,300 people on average in previous years. Washington County, about 4,000 people on average in previous years. So that's about 20 people a day is the population growth in Benton County. About 10 people a day is population growth in Washington County. So put together, Benton and Washington County, that's a population increase of 30 people a day in in Benton and Washington County put together over the last several years. And I can assure you that we have not built anywhere near that amount of housing to keep up with that growth. So this chart kind of shows that in a different way. This shows population growth in the previous decade, 2000 to 2010, and this most recent decade between 2010 and 2020. We obviously had faster population growth in that previous decade. We were working off a smaller base at the time, and we did indeed have more people moving at that time to Northwest Arkansas. But we actually, as those of you that were here in 2008 know very well, we did overbuild in that market. So you can see that population growth is slower than the growth in the number of housing units in Northwest Arkansas. And as a result of that hangover and zoning issues and so on and so forth, population growth did go up in this most recent decade, but not as fast as housing units. The growth, so it's both a hangover from what happened here in that decade between 2000 and 2010, but also because, we are sort of kind of limited in how much we can develop by what we've zoned our land to accept at this point. So this is another way of showing you that, this was the overbuilding time. This shows you how many complete but unoccupied homes are sitting on active subdivisions in Benton County. This was the peak of the crisis. This is where we are today. It's essentially functionally zero. At no time have we ever gone back to a subdivision and seen the same house sitting empty between two halves. So same story in Washington County. The number of complete but unoccupied homes is functionally zero in Washington County as well. Here's another way of showing you that county-based chart. So this shows you population changes and housing production in the cities in Northwest Arkansas in that previous decade between 2000 and 2010. Again, you can see certainly in some of the bigger cities, we did end up overbuilding. The housing production outpaced population growth. That is the opposite of what's happening in this most recent decade, where at least in our bigger cities, housing production is not keeping pace with the population growth, which is why you see an increase in home prices in our region. This is probably not the best metric to show you how much land is available to develop. This simply is empty lots in active subdivisions. It does not take into account, say, lots that are underutilized or, in our downtowns or commercial areas. So there is, say, a lot more land available to develop. It's just not, it's either currently being underutilized, it's underzoned, or it's not being zoned for residential uses. But this is simply looking at the inventory of land that is zoned as residential and is in an active subdivision that is being developed. And you can see that the number of empty lots continues to shrink. In Benton County, we're not expecting a whole lot of lots to be added to this inventory in the near future. Same story in Washington County. You see the number of empty lots continuing to shrink in Springdale, in West Washington County. You do see a small increase in the city of Fayetteville. And again, I said that the city of Fayetteville has been developing a lot more housing than some of our cities in Northwest Arkansas. And we are seeing some additional developments in the pipeline in the city of Fayetteville. But as I said, the current composition of the city council probably ensure that that level of growth will taper off here. What does this mean for our region? I've probably shown this chart in other places before. This chart shows you the land's share of the overall price of a home being sold by region, by zip code. And you can see that the redder the zip code is, that means the higher the home price reflects the price of land. So the more expensive the land share of the overall price of the home being sold. And you can see how that compares to some of our surrounding regions. So this is the Dallas metro area. Again, land is an expensive component of the final price of homes being sold. But say Tulsa, that's not the case. In Central Arkansas, that's not the case either. And depending on where you are around the Memphis metro area, that's not the case either. So when we look at some of our peer regions that we compare ourselves to in the State of the Region report that we do annually with the Northwest Arkansas Council, you can see some differences here. I mean, like again, Austin, this is a region that we just displaced in the best places to live ranking. And you can see how much more expensive the land is in the city of Austin and the surrounding region, and how much it contributes to the overall price of the home. And then you see sort of a different story going on in the city of Des Moines. And I did want to highlight that because that is a city which is a peer region that we compare ourselves to as from Northwest Arkansas, that has had quite a bit of growth in their downtown area, especially in the last decade. They nearly doubled their population of their downtown region. They more than, I think, a third of the population growth of the entire city happened in downtown, and it accounted for more than half of the new housing units in the city of Des Moines in the last decade. So there aren't often too many great examples of cities in the United States dealing with the housing crisis in any meaningful way by encouraging denser urban developments. But I think Des Moines is a case where you are seeing some of that, even though that is, following a remarkable story, but probably the most unremarkable picture of a downtown, because it just fronts a huge parking lot here. If they'd simply taken the picture from the other side there, I think it would look a whole lot better. The issues that we have in Northwest Arkansas, again, around housing affordability is obviously, as this chart shows you, housing is a lot more expensive in our cities, is a lot less expensive in the suburban areas outside of cities, which should not come as a surprise. But once you account for the transportation costs associated with living outside of our cities, most of our jobs tend to be along this corridor here. So it does increase transportation costs. So even if you are able to find a home that is, more affordable, and that is quickly diminishing as well in the areas outside our cities, you're still spending a lot on transportation. So overall, when you put your housing and transportation together, you're over that 45%, which is considered affordable in that metric, which is, again, not the case in the city of Des Moines. The city of Des Moines, the housing is affordable under 30%. If we're just looking at housing and transportation tends to be affordable as well. And then a consequence of all of that, obviously, is that the greenhouse gas emissions tend to be a lot higher for people living in the outlying areas away from the center of our cities. Again, this largely has to do with transportation and people having to commute to work routinely, then that does increase their household greenhouse gas emissions. So in the last couple of years, maybe people weren't commuting as much where they're working from home. But of course, offices are reopening right now. And so you're going to see this continue to be the case. Really quickly, I want to talk about a few things, few other things. You know, the number of home building permits is not at record levels. So we did sell a record number of homes. We have record home prices, but we were producing a lot more housing before the financial crisis in 2008. And we're not currently. And as I'd mentioned, again, we're adding, our population is growing in this region by about 30 people a day. We're not nearly producing enough housing to keep up with that demand. And then finally, when we look at what's going on in the multifamily sector, you know, if you've looked around our region, you'll see that we are building a lot of apartments. We have built a lot of apartments. We continue to build a lot of apartments, but the vacancy rate continues to go down. So the vacancy rate in Northwest Arkansas is about 3%, is down from 3.5% in the first half of 2021. Vacancy rates are 3% in Bentonville, 3.4% in Fayetteville, 4% in Rogers, less than 1% in Siloam, and 1.3% in the city of Springdale. The downtown vacancy rates in each of those cities tends to be lower than the overall average again. So 1.7% in Bentonville, 3% in Rogers. You know, essentially there aren't a whole lot of downtown units in Salem, but it's a 0% vacancy rate there and about a 0.01% vacancy rate in Springdale. We are seeing some development in downtowns, in several of our downtowns in these 4 cities, actually in all 5 cities, but so we should be adding to inventory in those downtowns in terms of multifamily housing. Similar to what's going on in the single family home market, rents continue to increase, but not at the pace that we're seeing single family home prices increase. So a 5-year increase in rents of about 25%, about 5% increase last year. The average rent is now about $790, from a high of say $950 or so in the city of Bentonville to about $720 in the city of Fayetteville. $650 in the city of Siloam Springs is the lowest rent. Fayetteville's rent is unusually low. That's in large part because there's a lot of buy-the-bed units in the inventory there. And so if you're paying $700 per unit for one of those buy-the-bed apartments, that's still $700 per room for a 4-bedroom apartment, which is actually expensive, but the way it's counted, because they're rented as buy-the-bed units, they counted as single units. So it does have a large inventory of those, holding the price artificially down. I think that is the end of what I wanted to talk about, and I think we will stop and take questions.
Super. Thanks, Mervyn. I'm going to switch to a gallery view here for some Q&A. We've got our audience today is primarily a community of practice of city planners. That is the true target audience for this event here. We're working by, with, and through the city planning community here in Northwest Arkansas to identify necessary policy reforms to ensure that our supply is commensurate to our demand and complementary to the forms of demand. So I say that first off to establish a little bit of context for everyone on the call today, but I also say that to acknowledge the questions. We host a fair number of these webinars, and oftentimes it's not as active on the Q&A as it is today, and I think that goes to show that you have that there's a lot of passion, a lot of eagerness to learn what's going on in the market. So thank you both for your inspirational and very educational presentations. But I'm really, thank you also to our community. I'm very excited to see these questions coming in. There's one here I want to jump in first on just making sure that we understand kind of the framing of the research and analysis that you all do. A couple of questions here regarding that. So the housing units, when both of you talk about, a residential unit, or are you including for sale and for rent in those? And the second part of this it relates to another question. What about architectural typologies? Are you thinking, single family units? Are you thinking multifamily units? Do you see variables in terms of the architectural typologies that exist in the data as you presented it here? And that's a question for both of you. Feel free to jump in either.
I'll jump in first and just say that I presented data on the housing market overall that included both multifamily and rental and single family. And then I presented a lot of data on just the single family market. I did not have slides that sort of broke that down. We have spent a lot of time, as I'm sure Mervyn and others have, on looking at sort of the missing middle, which is something we've all talked a lot about. And I think, by and large, what we've seen is on the for sale side, housing really shift to predominantly single family and not enough in the way of missing middle type housing or higher density housing in the last 10 years or so. I'd be interested to hear if that's what you're seeing in Northwest Arkansas, but at a national level, that's definitely what we've been seeing. We have seen, just in the last couple of years, an explosion of the single family rental. And by single family, I include townhomes, more sort of the cottage style, single level, detached apartment stuff, that we've seen a lot of that being developed by Next Metro and other people like that. And that's partly a response to the lack of missing middle housing on the for sale side that's been dominated by single family homes, some townhomes getting built, but by and large, a lot more opportunity for a more diverse range of housing. I don't have any, I did not create slides on that today, unfortunately, so I can't, I don't know if Jabara has that, but for Northwest Arkansas, but generally that is the trend that we're seeing.
Greater diversity. I think that's the phrase that pays. There's an appetite for greater diversity and typology.
There it is.
That what I'm hearing you.
So one of the things we've done, and unfortunately I'm not good at sort of talking and digging on my laptop for slides, but one of the things we've done is we've done some consumer research where we've looked to see, how much demand there is for other forms of housing besides single family or conventional apartments. And the short answer is, while we see a lot of demand for single family, we do see more demand for a broader diversity of housing than we're actually building.
Great point. Mervyn, do you want to jump in right there? Any observations for our region?
Yeah, so our data tends to, so when I show you average home prices, that database is almost entirely dominated by unattached, detached single family housing. So it's that's the majority of housing that gets built around here in Northwest Arkansas, and that's the majority of the existing home sales. But within that, home sales is also, like I'm going to joke that there are 10 condos in Fayetteville. There are more than 10 condos in Fayetteville, but like if they sell, they show up as single family home sales in that place as well. So like, especially when you look at those downtown sales, there is, a greater inventory of townhouses or condos or things like that in that inventory. But it's, again, as a percentage of the overall, it's negligible at this point, because as Gregg said, I think we've talked endlessly in this region about building this missing middle housing, and it's just time to build the missing middle housing and stop talking about it. But there are policy,
I would like to inquire about the policy piece. In general, do you want to speak to Gregg's assessment that there's an appetite for greater diversity and typologies?
I think so. When you talk to people around here, I mean, when you look at the composition of people moving into this region, they tend to be younger if they have children, not usually more than one. And they are interested in buying houses and they would like to live. We've invested as a region in all these nice amenities. We have museums, restaurants, bars, bicycle trails. They're not outside the cities. They're in the cities. They're, sort of along the central corridor, but there isn't enough housing there. So you end up where people move to this region, they want to buy a house, they end up buying a 3-bedroom house or a 4-bedroom house outside the city, which is a lot more house than they want or can functionally use, but they're forced to do that instead of And so it might look like, oh yes, people want single family homes, but that's not actually the case. That's all that's available for them to buy. So we're not producing, you know, but I would, look at just the evidence on the low vacancy rates in spite of how much we've built on the multifamily market. So there's clearly significant demand for all of that in this region. We're just not building it.
I'll wait to the end. I want to get to some of our guest questions, but I may, if there's time at the end, I would like to circle back to one of your slides in particular, where between 2017 and 2020, we saw a net decrease in average home sale price in the city of Fayetteville, and you attribute that specifically to production. Maybe I'll follow up with you if we run out of time here today, but I want to investigate that a little bit more. So I'm gonna, but I'll pause. I'll pivot back to some of the questions from our guests. So Nicole, this is for you, Gregg. Nicole's curious about master plan communities. I'm sure you've had a chance there to review the questions. We're not seeing much here in our region. Do you see any trends emerging here in the heartland and smaller mid-tier cities as far as these master plan communities? And what is your assessment as far as impact to costs in those?
Sure. We were actually engaged to work with a developer in Fayetteville who had some property to do a planned community development. I'm not sure that that's gone forward yet, but I know there was some thinking along those lines and a site. I can't talk about it because that was their program. But I think in general, while there's greater demand for master plan communities, and master plan communities can be a place where a greater diversity of housing works well because they have the amenities, and because of the master planning, you can create more open space or shared, parks and open space and things like that. So you can orient a higher density for sale product, for example, to a pocket park or something like that, because you have the opportunity to do that, which can help, to add that missing middle. I would say, what we're seeing trend-wise, unfortunately, among the master plan communities we surveyed this last year, some greater diversity of housing and a lot more interest in doing the single family rental within communities as a way of reintroducing some entry-level product that's really been missing there. But farther to go. The master plan communities, because they have amenities and because of the master planning and the amenity and the lifestyle, sometimes they're getting a little bit of a premium over the builder subdivision down the street. Although they also are the place where you have the opportunity to do more of that higher density or missing middle product, as I mentioned, because of parks and open space. We haven't seen it done to the degree that I think the opportunity exists to do that.
Super, very helpful. Thank you, Gregg. Mervyn, I'm going to pitch to you. Donna has a question about Centerton. Do you think that Centerton's going to continue its extraordinary growth? I would say Centerton is one of many peripheral smaller cities along the corridor that are recognizing this extraordinary growth. You mentioned West Washington County in your presentation multiple times. Obviously, when I think of West Washington County, I'm looking primarily at the Farmington and Prairie Grove communities. Pea Ridge is exploding in growth. The list goes on. Mervyn, generally speaking, what is your overall assessment to rapid, extraordinary growth in the smaller communities along the 49 corridor here in our region?
Well, I think Centerton is a great example because, Bentonville, I want to say it's landlocked, it's not the right term, but they're very surrounded by a lot of other communities that have annexed land around them and are growing. So there isn't a whole lot of room to expand for the city of Bentonville itself. But, obviously the greater opportunity there lies in trying to rezone existing land that's being underutilized. Fayetteville has a lot of land out west, so there's still, quite a bit of appetite developing out that way. But obviously, if anybody's been on Weddington any time of day, you know that is a nightmare infrastructure-wise. So building all that housing there does have long-term problems for the city as well. But so that the reason you're seeing a lot more activity in Centerton, obviously, is that people want to live close to Bentonville, and that is your option. But I can, in high traffic, get from Fayetteville to downtown Bentonville in maybe 40 minutes, and normal times maybe 30 minutes. it probably takes somebody from the outer edge of Centerton trying to get to downtown Bentonville about 30 minutes. So that's, when we talk about regional commute times, that's going to become a real problem in terms of transportation infrastructure here and the costs associated with that. So that should not be the case. Centerton is so close to downtown Bentonville, but because of the way the development patterns have worked there, it's getting to be, especially in high traffic, taking about as long as it takes me to get to downtown Bentonville from downtown Fayetteville.
Concur. I can confirm that because one of my staff members that's with us today, Megan, she spoke about that this morning during our staff meeting, that exact thing, as a resident of Centerton herself, getting back to the corridor. So H plus T, housing plus transportation, will continue to be, it's obviously part of the math. They're inextricably intertwined, and I think that will continue to be a truth about land use forever. Piggybacking on that question about Centerton and some of the peripherals, Taylor wants to know, she's a planner up in Bella Vista, and she's curious about land acquisition. I would say more generally, this is, you talked about the number of lots available. Are you seeing in your analysis any patterns on lot average increase of lot sales for those subdivisions that are available? And in general, anything you want to speak to in terms of land acquisition broadly?
That is something that we're about to start working on in terms of like tracking land prices and land acquisitions. It's not something that has been part of our database, so that is, you know, upcoming soon, I would say, but that is not something we do. And, you know, as far as the city of Bella Vista, we don't track subdivisions the same way that we do in other cities. A variety of different reasons. Obviously, that was the development pattern in Bella Vista is very different than how it is in other cities. And the other reason is we are now using a lot more technology to track home building and subdivisions. But when we first started out, and we still do use this. You know, when we say we know exactly how many homes are unoccupied, that's because people are driving those subdivisions and observing homes from the street to observe whether they're occupied or not. And we use students to do that, and we don't trust them to drive on the hills in Bella Vista and park their cars and safely observe homes without rolling back. So we don't do that in Bella Vista.
Question for both of you. So we got a question about agriculture, and in particular, some of these Midwestern cities that do depend greatly on their agricultural economy. And what is the push-pull? I'm going to frame this in terms of a push-pull with the urban growth boundaries. And I mean small, uncapitalized, common phrase, urban growth boundaries, not the proper noun of the planning tool, urban growth boundary. How does that push-pull between the agrarian economies, especially here in the Mid-South, impact the overall growth? Are there, in your mind's eye, should we be thoughtful? Do we fully understand it? Is the first question, or do we just allow the sprawl to happen and we consume the agrarian landscape? And then in your mind's eyes, are there patterns associated with that push-pull of outward expansion into agrarian areas? And I say that recognizing that we depend greatly on agricultural production here in Northwest Arkansas. It's a significant contributor to our economy here in the two county areas. And I think it's on the tip of everyone's tongue, as evidenced by this year's Leadership Benton County symposium last month on the topic of agriculture. So very important to discuss, and I'll leave the floor to either of you that want
to. I'll just jump in and share some national trends, then Mervyn can share what his perspective is locally. Nationally, I think there's an assumption out there about protecting agricultural areas. And if you look at the supply of agricultural land, and you look at lands that are not put in production versus those that are, what the trends have shown, there have been some studies on this. I think you can go to American Farmland Trust and look at some studies that they've done that have shown that net losses of land to development for agriculture have not been that tremendous that other lands have then been put in production. And what we do see happening is that land cost, which Mervyn pointed out, is a big contributor to housing costs. And I think sometimes on the regulatory side, we put barriers in place, well-intentioned, but we put barriers in place. Agriculture is a business. We tend to assume make some false assumptions about agriculture. One is that, this is pristine green fields that we need to preserve for open space, and it's not. It's industrial, and so that's first off, that's an unfair consideration. Second of all, when we draw, you do need to have urban boundaries and think about how you're really maximizing the lands that you have, so that you're doing a good job of utilizing the infrastructure that you have. But we find in a lot of places that infrastructure is very well utilized, and also the people who live in those existing areas. There's this thing called "not in my backyard," or NIMBY or banana, build absolutely nothing anywhere near anyone, or whatever the acronym is. And so we underestimate just how easy it is to go in, or we overestimate how easy it's going to be to go in and do infill. Infill is a terrific goal, and capitalizing on existing infrastructure is a terrific goal. I think sometimes, though, in planning circles, we assume that we can do more of that than we can, or that the neighbors in those areas want as much of it as we think they do, or that the infrastructure is going to support it, or that there aren't going to be unintended consequences like adding a lot of costs and making housing less affordable. So we don't do a good job of sort of considering all the variables. We're typically wanting to sort of push those uncomfortable variables off onto another player. And so I think, generally when we have fast growing areas, we do need to be thinking about where are we going to create new centers, new activity centers. The other thing that happens is our existing activity centers, our downtowns, our suburban activity centers, they can only grow to a certain size, partly because of how people get to work. People get to work on major transportation arteries. You can only move so many people on and off of those arteries every day. You can try to put more housing there locally, so you're not having to move people on and off. But what you see is that you hit a wall at some point. And so, and there's a lot of hesitation with expanding those urban growth boundaries. And so, thinking about where can you expand those boundaries to provide more attainably priced housing? Where is there existing property, or existing lands not currently in production or not at the same levels of production, so that you can do a good job of compensating for those lands, those agricultural lands that are displaced by development, because development is going to displace agricultural lands. We know that. We've seen it happening, for a long time. So be smart about it. I can't speak to exactly, how that plays out in your area. That's something you need to think about. But I can certainly share a lot of examples of where that's happening in other places, and without throwing anybody under the bus, we could do a better job. So Mervyn, over to you. Perfect setup, right?
Well, I think, we are seeing to some extent some of that happening. We don't have like row crop agriculture here in Northwest Arkansas, but we have a lot of ranching going on. And I remember when I first moved here, I came in at night, so I didn't see this, but I was going back to the airport to leave, saw how many cow pastures were around.
Which is industrial. We should point out, not green space, it's industrial.
Yeah. And so it was all, ranch land. There was a lot of cows on the way to XNA. And like today, maybe aesthetically, it depends on your point of view, I suppose. There's a lot fewer cow pastures. So if you're coming into Northwest Arkansas, especially if you're driving south to Fayetteville from the airport, you're not driving past, somebody drops off and it's not big bales of hay and cows and everything. There are subdivisions, there are homes all over that area coming in. But that was not the case 10, 15 years ago. It was all agricultural land. I mean, it was all ranching going on over there, and that has been displaced already in Northwest Arkansas. And you still see, to some extent, for sale signs advertising commercial or residential development on pasture that is currently out there. So you'll see cows hanging out by a for sale sign, and so eventually someone's going to buy that, and those cows are no longer going to be there. So there's local food movement, the idea that we want to grow our food more regionally and so on and so forth. Because of the way we are developing, we are pushing our food growth further and further away from where we live today.
So I learned something last month at the agricultural symposium at Leadership Benton County. Benton County is the 9th largest agricultural economy for any county in the U.S. I want to say it's over $500 million, like $530 or $590 million annual economic impact, and that's just Benton County. And so what are we doing to make sure it is a business? To your point, Greg, it is a business. What are we doing to make sure that that remains an effective part of the Northwest Arkansas economy while supporting development? And I would encourage everybody to go learn about, I think it's Fayette and Lexington counties in central Kentucky, and they do a pretty good job. I think, to my planners in the room, definitely encourage you to go look around in the Lexington metro area and see how Kentucky in particular is managing that push-pull relationship between their bluegrass surrounding areas and the economy that's based on the thoroughbred landscape, and then obviously the fast growth in Lexington. Before we jump into politics here at the end and start talking about what's going on in the city of Fayetteville, Mervyn, real quick, based on absorption rates that you're seeing here in our region, and Greg, I think this is relevant nationwide as well, what should cities be attempting to achieve in vacancy rates for residential units based on what you guys are seeing in absorption?
I'll just jump in real quick because Mervyn knows the local answer, but I'll just say, the trend has been that we have much lower vacancies than we used to. And I think that was healthy because it gave consumers more choice, and it took the pressure off of home prices. And so vacancies have really tightened up quite a bit, and that is a factor. I don't know that there's a magic number, except to say that they're probably half what they were 10 years ago, and that limits consumer choice, and is pushes up prices, and it's bad for affordability. So
Yeah, I don't have a magic number on vacancy either, except, I think 10 years ago, the vacancy rate in the multifamily market was, about 10, 12, 15%, and people weren't losing money necessarily. They're certainly not when the vacancy rate is 3% right now. So
you had some really interesting numbers, Mervyn. You were looking at the ratio of housing production relative to population growth. And I think what we saw in the past was, and I will throw out a number, that typically housing production was about 10% over household growth. And now it's tracked even to below household growth. I don't know if that's consistent with the numbers that you were showing earlier.
That is very consistent with our bigger cities, especially.
Yeah.
Yeah, I mean, it's absolutely worth screaming from the rooftops, pardon the pun, about that particular number. Very impactful. I think this is important. We're gonna use Fayetteville as a guinea pig because it was mentioned a couple of times. You mentioned it, Mervyn, as well. We understand how the dynamic is changing, but you're also welcome to speak broadly to political will and the courage it takes to make bold moves that you guys acknowledge are necessary. Some pretty bold moves in the housing market. It's going to take political will, a lot of courage, and we also have to recognize that current residents, have a vote. That future residents, that will impact future residents. Current residents are given a higher stock value than the residents who don't live here yet. I think that's part and parcel to just the city council meetings, right? What's going on during the public hearings. How are we going to manage, specifically, Mervyn, you're welcome to address Fayetteville and some of your thoughts and concerns there, but broadly speaking, how do we make sure we manage this conversation? It's a pretty emotional conversation about political will and fear from the NIMBYs, to use your phrase, or the bananas, Greg. How do we navigate this? Do you all have any recommendations for how we move forward with this very significant challenge?
I'll talk locally. I don't know if Greg has some ideas on the national, but I did write down bananas. It's the first time I heard of it. It was build absolutely nothing anywhere near anything. Is that what it is? I'm totally going to use anywhere. Okay. I'm totally going to use that now. I think without ascribing ill will to people, I would say that, first order would be trying to educate people. I think, there is a lot of misperception about what growth means to a region. And then, again, people that have lived here for a long time, or people that have been born here or so on, say, well, the city has changed. I would encourage them to go to other parts of Arkansas that are struggling. Like, they would kill for 1% of the growth that we're seeing here in Northwest Arkansas. And, I've said this repeatedly, and I'll say it again, there's no stable middle. It's either you're growing or you're not growing. And we do not want to be in the not growing category. There are significant issues that, people don't understand. Like, we can keep the city the same without growing and we'll thrive. We won't thrive. That is on the way to being in decline. So what we need to do as a region is obviously manage our growth, in a sustainable way, which we're not doing at this point because home prices are clearly not sustainable. So I think, one is obviously talking to people, on city councils and the general public about what the needs of this region are and how we plan to address them. We're not banning single family homes. We're not, if people want a single family home, they can have a single family home. If people want to have parking for 5 cars on their lot, they can have that. We're just not going to require that of everyone. We shouldn't, if it's my desire to live in that type of housing, I shouldn't require it for everyone. So that's one aspect of it. The other, and I think is very important, is that there is not a consistent advocacy group for housing in Northwest Arkansas. I know that you and I are members of a YIMBY group in Northwest Arkansas, but again, it's not a proper advocacy organization. And I think the biggest problem is that we find, over time, I did mention the Fayetteville City Council composition changing only because I live here, a lot more closely involved with that one. There were members of the city council, for example, that were very pro-development. They saw the problem, they understood the problem, and they were like, you know what, we need this housing. Yes, the neighbors do not want it to go from 6 units an acre to 8 units an acre, but we do want the city to grow and we want home prices to go down, and that's okay. But then there are other members of the council that might vote for developments as long as a significant number of neighbors don't show up and complain about it. It's very often there's not the opposite side. The only person advocating for development is the developer or the person selling the land and asking for a rezoning. And 10 people from the neighborhood oppose it. We're a city of 90,000 people. We can't make a choice to not add 400 homes because 10 out of 90,000 people said no, right? But there is no organized advocacy in any of our cities to build more housing. And I think that is, education is important. Obviously, that would be a mission of whatever advocacy organization there is, but there is a need for advocacy on a routine basis. And it's not easy work because you're talking about 4 big cities, each with their own city council meetings where these issues repeatedly come up. And it's not just the city of Fayetteville, you have the same NIMBY problems in other cities as well. So who's going to show up at these city councils and provide city council, who are residents of that area and say, actually, I live in the city too. I may not be a neighbor of this development, but as a city resident, I get a vote in, encouraging growth in my city in this sustainable manner. And I think that's what's really been missing in this region.
Wonderful. Gregg, any input on overcoming that challenge?
That was a great answer. I think education. I think even our zoning commission, our planning councils, our council members, come into those jobs sometimes because they were upset about something that motivated them to get involved. But they're also just ordinary people like the rest of us, and I think education goes a long way. I think that's I'll give a plug for ULI. I think ULI does a great job as an educational organization. A lot of regions have engaged in I'll call them sort of how shall we grow kind of exercises that help people understand what the challenges are and what the options are, and doing nothing not being a good option, or just blocking everything not being a very good option. So, to the degree that the ULI, there can be a partner and sort of helping to educate, and especially public officials need to understand what the challenges and what the options are. You mentioned, looking at other places like Kentucky, doing case studies and looking at how other people solved it. So you're not always trying to reinvent the wheel. So I think a lot of it comes down to education. I think, Mervin's suggestion there be an advocacy organization. ULI is not an advocacy organization; it's an educational organization. But it does help to have somebody who's speaking to those challenges. And I think ULI as a convener can maybe bring people together to help educate around what the challenges are. And so you're not starting from scratch. Sort of share. Here's what happens if we do this. Here's what happens if we do that. Here's what happens if we don't do anything. So people understand that some of the choices that we've made, we got into an affordable housing crisis in this country by the choices we made. Some of them weren't good choices.
I like it. I talk to people a lot about everything in their built environment is a choice. Someone is probably making that for you, and it's impacting your life in one way or the other. It's time to get involved in the decision-making process because every brick every brick in your city started with a decision, and those impact you. So I'm really thankful that you finished there. I know we're over time. I want to ask a simple question. It's going to be a fast one. I'm hoping, Natasha, it relates to yours. Natasha is just talking generally about the rapid increase and what is the impact of real success here. I think we were all raised with this rule of thumb of 30% of your total household income should go towards total household costs, right? That's always been the rule of thumb. I remember going back to like junior high, some career orientation class I had, and learning that from the earliest moments. I think it's safe to say that we're rapidly outpacing, America is rapidly outpacing its ability to provide total housing costs at 30% of household income, median household income. Is it time to change the goalpost, gentlemen?
I think the goalposts sort of changed without us making that decision already. I think there's a lot of people out there paying too much for housing because we've done a poor job of delivering adequate, attainably priced housing.
Yeah, and I would probably say that we should look at housing and transportation together, because you could
Absolutely.
say live in an urban environment, a downtown area, and not use your car as a whole lot. So you might end up paying 35% of your income, but not spending as much on cars. So
I don't think people understand. That's a great point. I don't think people understand the connection between transportation and housing costs, that people will drive further to find that affordable house, and now they're the ones in front of you creating traffic on your way to work. So if you figure out how to not be a NIMBY, then maybe they would be living in town and not clogging up the highway if they could find that affordable housing.
I said this as a joke in another meeting, but how cars have stickers on them that show mileage and efficiency. Houses need to come with these stickers. This is your transportation cost if you buy it, because at the end of the day, people go by sticker price, right? I mean, the reason why we put those stickers on cars is to show people what their long-term costs are. It doesn't help every single time, but at least people are looking at that information. And there's moves to put stickers about the energy efficiency of your house, for example, but we never talk about, okay, well, this house the sticker price is cheaper, but how much time are you going to spend commuting, and what is the cost of that to you on an annual basis? That should be added to your calculation, but that's not the cost that people look at.
Mervin, that should also be added to the city and county administrations calculations, because we know that that it costs a little bit more money to support that peripheral growth than it does to support the inner city growth. So I think the math matters is what I hear you saying there, is that the math matters. I appreciate the reminder on H+T. I could do this all day. I think we've got an awesome audience of city planners here who could as well. Appreciate the extra time, everybody. Gregg, Mervin, thank you so much for joining us today. Very impactful dialogue. I look forward to receiving your PDFs, getting those hung out on our website for broader consumption. To our audience, as always, we wouldn't be here without you. Thank you very much for joining us here today. Thank you to the Walton Family Foundation for supporting this year-long Align for Affordability program that today is a part of. Thank you to my ULI staff and team for helping pull this event off in a meaningful way. As always, you can find us at arkansas.uli.org, or just search for us on any one of the available social media channels. If you need anything, please reach out anytime. Thanks again to everyone, and we will see you at the next event.